Hello, everyone. Welcome to this week's Phillip research morning call. So it's a pretty busy week. We got quite a few stock counter update, as well as a usual technical analysis, Singapore Weekly, and also our Singapore REITs Monthly. So I just quickly get the ball rolling. Just a disclaimer, everything was for educational purpose only. So the first one will be Shopify. We released a report with the title First Year of Profitability. So the fourth quarter results were within expectation. Revenue grew 16% year on year. Margin expanded 5.5% year on year. Their biggest highlight is their MAU increase is above guidance. Their MAU was at 35 million in the fourth quarter. This change was their most considerable fourth quarter change in the company's history. The second one coming in would be the fourth quarter last year, which increased 28 million. So this surpassed their guidance by 10 million. Also, in terms of premium subscribers, they have 263 million, which also beat guidance by 3 million. So this growth is largely thanks to more efficient marketing effort and the spike in their popularity for video podcast. And also they have the successful rep campaign. So MAU premium subscriber grew at 12% and 11% year on year, and this supported total revenue growth. And the second one, I guess that's their highlight, is they're finally making a profit for FY24. So their gross margin was 32.2%, which is above guidance by 40 BPS. Gross margin grew 550 BPS year on year and has improved sequentially for the sixth quarter. And this is primarily due to their lowered content cost. So FY24 really marks their monetization year. Spotify really show off its pricing power. It tried to increase its price for its premium subscription 2 times. Once it increased 20% in April for the UK market. Another time is in June, where it increased 13% globally. But subscription growth still remain really strong despite the price increase. And last but not least, they have pretty positive forward commentary. It signals more monetization opportunities. So management has indicated that price increase will remain a key strategy for them to improve profitability in FY25. They're also thinking of introducing a super premium tier that has a higher margin. MAU growth is projected to fall due to seasonality, and also they're trying to focus more on growing their high-value users instead of trying to retain low-engagement users. And as a result, 2/3 of their new MAUs are expected to be premium audience, and hence we're gonna expect a much higher margin as well. So in terms of outlook, they've guided 16% year-on-year growth in revenue for the next quarter, which is driven by user and price growth. And like I mentioned just now, they're focusing on their high-value users, so their gross margin are expected to expand 390 BPS to 31.8%. So we think their fourth quarter result really shows Shopify's ability to efficiently monetize and reach profitability while at the same time growing their subscribers. So we remain pretty positive on Spotify due to its significant pricing power and continuous margin expansion. Yet their valuation seems rather full. Right now it's 63.4x for FY25, which is significantly higher than the average tech company of 48x. We roll over another year of valuation and we keep our assumption unchanged. Our DCF target price increased to 600. We downgrade from accumulate to neutral due to the recent share price gain. So that's all for Spotify. I'll move on to Shopify. So Shopify also released their result last week. So their fourth quarter revenue was within our expectation. Their PAMI outperformed due to they have a very disciplined cost management. Their revenue grew very strong, 31% year on year. This is supported by growth in both subscription solution and merchant solution. The subscription solution increased 27% year on year. This is mainly due to the growth in the number of merchants that they have on their platform, and also the increased subscription fee of around 30%. The merchant solution grew 33% year on year. This is due to the continued strength in their GMV and increased penetration of Shopify payment. So moving on to the positives, the first one, they're really a growth company at peak performance. So revenue grew very strong at 31% year on year. This marks their 7th consecutive quarter of growth exceeding 25%. GMV increased 26% year on year, their highest quarter growth since the pandemic peak of 31%, which is in FY21. So the key driver here is both growth from existing merchants, especially the premium ones, and also growth in new merchants. Shopify, right, currently they hold only 12% of US e-commerce market and just 1% of the global e-commerce market. So we're quite positive on its long-term growth potential, especially because its unique business model kind of shields it from direct exposure to tariff, because it primarily offers e-commerce solution rather than trading physical goods directly. It also limits the disruption from AI because it's a very integrated ecosystem of services. It's not easily replaceable by automation. So both kind of give us an edge compared to its e-commerce competitors. The second positive would be their cost discipline. Gross margin declined 1.5% year on year. This is impacted by higher cloud and infrastructure hosting costs, as well as partnership-related headwinds, both of which are not expected to have long-term effect. However, despite that, their operating margins still improved by 3.1% because they have very strong operating expense leverage. They have a very prudent workforce management. Right now, they have 8,100 employees versus 8,300 in the last year. So this really helps contain their operating expenses. Their operating expenses only rose 14% year on year, despite it churning out 31% year on year growth in revenue. So this really demonstrated their strong ability to drive profitability. I guess if you talk about negative, the only negative they have would be a slightly soft outlook. So they imply a revenue growth of mid-20s year on year in the next quarter. This reflects a slowdown from the previous quarter, but it kind of aligns with our expectation considering seasonality. So Q4 is usually the strongest quarter. There's also the impact of the lapping leap year last year, foreign exchange, and a degree of conservatism, especially because their management exceeded the high end of its guidance by 2% in the last quarter. Shopify also have a track record of giving very prudent outlook, so they consistently outperform their outlook. We think overall Shopify posted another strong set of results. Their number of merchants continues to grow, price is increasing, operation margin has been trending upward, and we believe Shopify is really in a class of its own in the e-commerce enabler industry. We expect the company to stay in leadership position through its unique web of business model that boosts the stickiness of its customer. So we hear a lot of story where a lot of customers, they opt for only one part of Shopify's services and they end up adopting the entire ecosystem of Shopify. So this setup really shields it from a lot of challenging market conditions that its normal e-commerce competitor face. However, we think the valuations are rather full. Their FY25 PE ratio is already 110x. This is almost double of their 3-year average, which is 52x. And if you compare with Amazon, Amazon only has 36.7x, while Alibaba only 12.2x. So we see very limited upside potential, like at the current price. It seems to already fully respect the company's growth potential. We roll over to another year evaluation. We increase our revenue, FY25 revenue by 2% to account for the higher growth in both subscription solution and merchant solution. We increase our PATMI by 38% to account for Shopify's increased cost discipline. So our DCF target price rise to $140. Due to the recent price performance, we downgrade our recommendation from buy to accumulate. So that's all from me. I'll pass my time to Ikben to talk about BRC Asia.
Thanks, Helena. I'll talk about BRC Asia's most recent first Q25 update. For their revenue and PATMI is within our expectations. Revenue fell slightly year on year because there was a decline in steel prices and also because of safety timeout incidents last year in November. As for BRC Asia's positives, they achieved their highest ever order book at $1.5 billion. This can be seen by the red line in the graph in the bottom left hand. And as for their negative, we do see further decline in steel rebar prices because of the weak demand from China's construction sector. And because BRC Asia's revenue is closely tied to steel rebar prices, we do see it affecting their revenue slightly. And we also see some engineering drawing delays this year because this is consistent with the narrative from other construction companies as well. As for our outlook, we do see increasing construction demand over the next 4 years because the BCA actually revised their forecast for the next 4 years. And we also see a lot of major construction companies happening within these 4 years. For example, the Changi Airport Terminal 5, as well as the integrated resorts expansion. And we think that most of the order book can be complete within the next 3 years because there's because Changi Airport Terminal 5 will start construction in the first half of this year. So there's more visibility over within the medium term itself. For our call, we maintain accumulate and we raise our target price to 3.15 from the previous 2.80 because we lower our WACC to 11.6% from previous 12.6% because of the increased visibility. And there's no change to our revenue and PATMI estimates. I think overall for BRC Asia, because they do have a very large market share of 70% of market share within in the steel segment of the construction segment. And because all construction projects will need steel itself. So this uptake in construction over the next 4 years will greatly benefit BRC Asia. And this is reflected in their strong order book as well. So we are quite positive in BRC Asia and maintain and accumulate in this stock. Next slide, please. Okay, I'll be presenting on Phillip on the ground for Applied Materials as well. Applied Materials recently released their first Q25 results. They are a company with 138 billion market cap, and they supply equipment to used in semiconductor manufacturing. So their key customers include TSMC, Intel, and Samsung. For their revenue itself, it increased by 7% year on year, and this is driven by a 20% growth in foundry logic and offset by a decline in memory DRAM sales because prior sales to China did not repeat. As for their profits, they recorded lower net profits because there was a one-off renewal of tax rates for their tax assets in Singapore. However, this is a non-cash adjustment. So if we strip out this particular one-off adjustment itself, the adjusted net profits actually increased from the adoption of AI equipment. As for our outlook for Applied Materials, um, management did guide that China will make up a smaller proportion of their revenue because of weaker sales from China. And because China makes up such a big portion of their revenue at 31%, as seen from the bottom right-hand corner, this will have a material impact on their revenue itself. However, we do see strong demand for their gate all-around transistors, and this particular technology is used to scale 3 nanometer chip manufacturing. And this 3 nanometer chip manufacturing is the chip being used to manufacture AI chips used in the AI chips used with AI capabilities. So in general, this is a very strong narrative for the entire semiconductor segment because this shows that TSMC sees a very strong demand and has been ordering this gate all-around transistor technology from Applied Materials itself. Yeah, so that's all from my end. I'll hand over the time now to Glenn. Thanks.
Hey, thanks, Iqbal. Yeah. So for for us, for the banking side, there's DBS. I mean, that's I guess the biggest results last week and the main highlight. So for DBS, the adjusted fourth quarter adjusted PATMI of 2.6 billion was in line with our estimates, with their full year FY24 adjusted PATMI 100% of our forecast. The DPS did rise, the ordinary DPS did rise by 22% year on year to 60 cents, with the full year FY24 DPS at $2.22. So that's a 27% increase. I think more interestingly, they also did give this additional capital return dividend of 15 cents per quarter. So it's starting in the first quarter of 2025 and for the full year. So we expect that this return will sustain over the next 3 years. I'll go more into detail into this later on. The main key highlights, if we look at the positives wise, the net interest income and net interest margins have risen. So this was really backed by the loans growth of 3% year on year, and also that their net interest margins have risen by 2 basis points to 2.15%. So resultantly, we have seen the net interest income rising by around 9% year on year to 3.7 billion. For 2025, in January, the exit NIM was around 2.12%, and they are expecting the FY25 full year NIM to come in at around 2.1%. So as expected, it is a slight decline from the 2.15 that we saw in fourth quarter of 2024. So this is to be expected. The other positive was that the volatility has benefited the trading income. So we have seen volatility in the fourth quarter, mainly coming from the US elections. really benefit the market's trading income, which surged by 40%, and also compounded by the fact that there was a very low base the previous year. As for wealth management income, it has continued to grow. It also surged by 41% year-on-year, as there was an increase in fee income from this continued shift from deposits into investments. And also the AUM expansion has continued. It was up 17% year-on-year. The net new money inflows were quite healthy at 6 billion for the fourth quarter, and in total it was around 21 billion for FY24. As for negative, there's really only one negative, which is that their allowances and expenses have risen. So allowances rose, provisions rose mainly from this increase in specific provisions, but it's not really due to any particular account, but mainly from lower upgrade settlements and recoveries during the quarter. So that's why we saw this spike up in the specific provisions. So resultantly, we have seen their credit costs increase to 20 basis points. But if you look at their full year credit costs for FY24, it was coming in within their guidance. It came in at 13 basis points. They guided at around 10 to 15 for FY24. I think more interestingly is that they have maintained their management overlay of 2.3 billion. So this really acts as a buffer to increase the GP write-backs if SP comes in higher than expected in 2025. So this will offset some of the SP, and provisions will maintain quite stable. On the expenses side, the higher staff cost has resulted in expenses climbing, but nonetheless, their cost to income ratio dip slightly year-on-year to 43.5% as the revenue growth outpaced the expenses growth. For 2025, they're expecting the CIR to be, or cost to income ratio, to be around the low 40% range. So quite a similar cost to income ratio moving into this year. For the outlook, the main story that I think is all over the headlines is that they're starting to return capital. And since they're the first bank to announce their results, they're also the first bank to start the capital returns. So their CET1 ratio was still up this quarter by 50 basis points to 15.1%. And this is the fully phased in one. So it is the upper end of their target operating range of 12.5% to 13.5%. So they did commit to this 3-year management plan to manage down their excess capital, firstly by maintaining the annual 24 cents dividend increment, which equates to 6 cents per quarter. This was announced way back during their investor day, I think almost 1.5 years ago in May. And secondly, by introducing this new capital return dividend of 15 cents per quarter for FY25. And but this capital return dividend, they said that they could sustain it for the next 3 years, so 2025 to 2027. But they're only giving the details for 2025, saying that it will be 15 cents per quarter. We're not sure yet on how much they'll be giving for the next 2 years, like 2026 and 2027. And last but not least, they're also giving this 3 billion share buyback program. They haven't given any details on the timeline yet, how much will be bought back and for which period. Yeah. And all this is on top of the fact that they still have their MAS cap of 1.6 billion on their capital. So they are already giving back so much, even though they have that cap. So if the cap were be to remove, which they are, according to management, they said that there is a possibility that they could appeal to MAS again and get it removed once they have gone through all the proper processes for their IT side. So all these new capital return dividends, what does it mean is that they would increase their FY25 DPS to $3. It's an increase of 35% year-on-year. And equates to around a dividend yield of 6.7% based on a $45 share price. And also that this dividend this dividend of $3, it also would increase their dividend payout ratio. So currently it's around mid 50%, and it will increase it to around mid 70% payout ratio for DBS. For the other outlook, we are seeing that the non-interest income would really be driving the growth for DBS. This will be mainly coming from their wealth management fees as well as treasury customer sales. And we expect this momentum to continue as the volatility remains high surrounding this Trump administration, and it would benefit the trading income. And on the fee income side, it will be sustained from the wealth management as investor sentiment continues to shift and AUM inflows also increase. So for 2025, we are expecting a growth of around 9% for non-interest income. For the net interest income and PATMI guidance, they didn't really change their guidance that they provided the last quarter. They changed it a bit, so now they're just saying that the net interest income will maintain at 2024 levels. mainly from loans growth, which will be offset by a slight decline in NIMs. For the profit before tax, it will be around the 2024 levels. But I think the key point here is that their PATMI is expected to decline from 2024 levels, mainly due to the new global minimum tax of 15%. So currently their average tax rate across the group is 12.2%. Yep, so it's coming from this base erosion and profit shifting, or BEPS 2.0 initiative, and it will increase their tax expense by around $400 million, which equates to around 24% year-on-year increase. So for DBS, we upgrade to an accumulate with a higher target price of $46.90 as we roll over our valuations. And like I mentioned earlier, we do expect that non-interest income will be the main growth driver, as the heightened volatility and will benefit trading income, while the continued growth in wealth management from the shift in investor sentiment as well as AM inflows. But this higher expenses and provisions, as well as the higher tax, will hurt the PATMI in FY25. And this capital return initiative that they have started and a 6.7% dividend yield are also very attractive. So that's all for DBS. Now let me move on to the next slide, please. Thank you. Yeah, so we have a Phillip on the ground on iFAST. We don't cover the company, but we'll just do a quick brief on the outlook as well as on the results. So for iFAST, their AUA has grown again. It grew slightly slower. If you look at the quarter-on-quarter kind of growth, only 6%, but year-on-year it grew by 26%. It has reached a record high of 25 billion. So their net inflow of client assets did rise quarter-on-quarter, but it fell slightly year-on-year. For their targets for the AUM, it's still saying they're still maintaining that 100 billion target for AUA, by 2028 to 2030. So this, if you look at 2030, it will be a CAGR of 26% year-on-year. So, if they continue on this track, then they would possibly be able to hit this 100 billion by 2030. As for revenue-wise, it was up 27%. Net profit was also surged by 50%. And it really came from the banking business because it finally turned around. So we have seen a profit in the fourth quarter of 0.3 million compared to a loss in the prior year of 2.6 million. So, they have followed their guidance. They said that fourth quarter they will sort of like turn profitable, or at least not be loss-making. And it did just turn around this quarter. For dividends, it was also up slightly to 1.6 cents for the fourth quarter. For dividends-wise, just to note that they have mentioned moving forward, previously they guided, they will try to pay out more, like up to 50% plus for dividend payout ratio. But now that they have this banking segment, they will be lowering that to maybe 20% kind of payout ratio, as they need the capital to continue growing their banking operations. So we will likely be looking at around these levels of dividends moving forward. For the Hong Kong e-pension business targets, it was really unchanged. Nothing much has changed. And last but not least, the iFAST Global Bank. Like I said earlier, it has turned profitable in the fourth quarter. The iFAST does expect it to continue to grow and achieve a full year of profitability in FY25. And you look at the customer deposits, it has also been quite healthy. It finally crossed the 1 billion mark, mainly from the digital personal banking. So all in for iFAST, I think the main contributor to their growth, and how they would be able to continue growth would be from this banking operations that they're having. It has turned profitable, so we are not sure how much faster it can grow into 2025 with the low interest rate environment. But I think that would be one of the main factors for the growth for iFAST. So that's all I have for the banking sector. I'll now hand it over to Miao. Thanks.
Thanks, Glenn. So FIS released the FY24 result last week, and DPO slide 1.4% year-on-year is underperforming our estimate. And the decline is attributed to 30% reduction in the risk manager's fee in units. So originally it was 90%, now it's down to 60%. And something positive about the rate is RevPAR rose by 5.7% year-on-year, and we do see improvements in both ADR and occupancy rate. And Far East also observed a growing contribution from Chinese and Indian travelers, while the demand for Malaysia and Indonesia still lags behind due to strong SGD. And with STB targeting international visitors arrival, will recover back to around 95% of the pre-COVID level. And in fourth quarter 24 was only around 82%. We believe RevPAR could continue to be supported by an improvement in occupancy rate. And the commercial segment led the performance, while service residents remain stable. Far East Hospitality Trust achieved rental reversion of around 4.5% for its commercial premises, and the occupancy rate also see improvement of 5.1 percentage point. And we believe the demand in CBD area remains strong, with positive rental reversion that may extend into FY25, given Far East premises is relatively, their asking rent is relatively lower compared to other like prime orchard retail space. And their occupancy for the service residents also dipped. This is because like 21% of the village residents inventory was under maintenance. Yeah, so we anticipate a low single-digit RevPAR growth in 2025, and all the maintenance work has already been done. Yeah, so now they're back to the Euro business, and the RevPAR growth is likely to be supported by the business recovery of business activities and also resident corporate demand in Singapore. And Far East is also looking at 10 to 20 basis point savings in interest cost in FY25. Yeah, and there's also no more refinancing obligation this year. And for outlook, Far East Hospitality Trust shared that the forward booking for first quarter 25 appears to be healthy and driven by the Chinese New Year demand, and also they do anticipate a decline in first quarter 25 RevPAR due to the absence of mega concerts. Since last year we had Taylor Swift and Coldplay. Yeah, but the decline wouldn't be sharp. So we are factoring a mid-single-digit RevPAR decline for first quarter 25. And our whole year basis, we can anticipate RevPAR to increase by a low single-digit. Yeah, given the supply is tapering off, and there's only 1.7% CAGR for the next 3 years. And yeah, so international visitors arrival will be mainly supported by various MICE events this year, like LIV Golf Singapore and also Semicon C 2025. Yeah, next slide, please. Yeah, moving on for FY24 result for Elite UK REIT. Yeah, so the results are in line with our forecast. DPU improved by 5% year-on-year, and this is due to a rising payout ratio from 90% to 95% in second half 24. And for positives, Elite saw portfolio valuation improve by 1.2% year-on-year, and they also successfully divested 3 assets, generating proceeds totaling of 6.2 million at an average price of 15% above book value. And this is showcasing their strong monetization capability. And they remain committed to their asset recycling plan. So we expect around like 33 million asset to be divested in FY25. And all the proceeds will be used to repay the debt. And potentially they're targeting to lower the gearing to below 40%. And even though Bank of England recently cut its benchmark rate by 25 basis points, but we don't anticipate any reducing financing cost. Yeah, since like they hash around 87% of the borrowing in fixed rate. Yeah, so cost of debt is likely to maintain at 4.9% this year. And we continue to like Elite and give a buy recommendation, essentially because Elite plans to maintain its payout ratio at 95%. And the REIT is also actively engaging with its largest tenant, DWP, for early renewal ahead of 2028. And they target to renew around 25% of the list this year. Yeah, so we believe it will substantially de-risk after the renewal. And yeah, they're currently trading at forward dividend yield of 9.7% and price to NAV of 0.7 times. Next slide, please. Yeah, this is a Phillip on the ground for Paragon REIT about their privatization offer. Yeah, so Cascaden has proposed to take Paragon REIT private at $0.98 per unit, and it will be pure in cash. And this is around 1.07 times of their price to NAV, and also representing 10.9% and 12.8% premium over the 1 month and 12 months volume weighted average trading price. Yeah, so unit holder will also be entitled to the second half cash distribution of 2.33 cents per unit. And the reason for privatization is that Paragon is likely to undertake a major AEI, which will cost 300 to 600 million over the next 3 to 4 years. And the rough estimation is that NPI is likely to decline by 10 to 40% during the AEI period. And assuming all the 300 to 600 million capex will be purely funded by debt, on a pro forma basis, gearing will increase from 34% to around 38 to 42% range. And also pro forma FY24 DPU will also drop by 20 to 40%, by 20 to 60%. Yeah, and given the potential income and also DPU fluctuation due to the AI, and coupled with like Paragon's low trading liquidity and also the challenging market environment, yeah, so we believe privatization seems to be attractive for unit holders. Yeah, so we recommend unit holders to accept the offer. And the rough timeline, yeah, sorry, can you go back? Yeah, the rough timeline is on the right. And yeah, so for the offer to be accepted, yeah, so there'll be like more than 50% of the unit holders should present and vote for the offer, and this will representing at least 75% of the total units. Yeah, so Cascaden, which currently holds 61% of the stake, yeah, they'll be absent from the voting. Yeah, thank you. Next slide, please. Yeah, moving on to First REIT. Yeah, so Darren is on reservist. Yeah, so I'll present on his behalf. And the result for First REIT is in line with our expectation. For positives, rental income in Indonesia grew by 4.7% year on year. This is in local currency term. Yeah, so exceeding 4.5% of the base rent acceleration due to the higher contribution from performance-based rent. So the income in Singapore grew by 2%, and Japan remains stable year on year. And we expect interest costs to remain stable in FY25. So we'll be at the 5% range level, and it will start to trend down in FY26. And the income from Japan is fully hedged till the end of 2025. But income from Indonesia is not. Yeah, so it's still exposed to FX risk. And for negatives, in first quarter 24, First REIT collected 2.4 million from MPU. And together with the security deposit of around 2.2 million, that was used to offset the rental. Yeah, so outstanding amount decreased from 7.9 million in third quarter 24 to around 4.6 million. Yeah, so 4.6 million is still owned by MPU. And First REIT also haven't provided any loss allowance for the outstanding amount. And for outlook, if Siloam successfully acquire First REIT's hospitality asset in Indonesia, the proceeds could be deployed to pay off the debt and also fund acquisition in more stable and also developed markets like Australia and Japan. So this will accelerate their 2.0 growth strategy. And in the meantime, First REIT continue to benefit from the 4.5% base rent escalation for its Indonesian hospitals, yeah, which could potentially offset the impact from the depreciation ADR against Singapore dollar. Yeah, so we maintain a buy with a higher DDM target price of $0.32. Yeah, next slide, please. Yeah, so moving on to Singapore REIT monthly. Yeah, so the REIT index was pretty lackluster in January 25. gaining 0.2% after falling 11.8% in 2024. Yeah, and the overseas commercial subsector was the top performer in January, gaining around 4%, and the worst performing subsector was industrial. Yeah, next slide, please. Yeah, so FY24 results were in line with our expectation and for the S rate under our coverage. And most continue to see year decline in DPU due to higher financing cost. And we expect DPU growth of around 1% in 2025, with more than 50% of the risk will benefiting from the interest saving in 2025. And however, the modest rate cut trajectory may limit the DPU gain. Yeah, as rates are now trading at a forward dividend yield spread of 3.4% and also price to NAV of 0.87 times. Yeah, which we consider that to be very attractive. Next slide, please. Yeah, so this is the chart for forward dividend yield and price to NAV. Yeah, next slide, please. Yeah, so for the subsector, our top pick is still retail. And retail reversion in FY24 was still strong, with the suburban mall experiencing high single-digit reversions, and the downtown malls was ranging from the high single digits to low teens, to low 20s. And landlords observed that there's robust demand for the space from overseas retailers, such as the Chinese F&B concept. And there's also like other emerging and creative F&B concepts entering into the market, such as cafes. And however, for the higher ticket item, including luxury goods and fine dinings, they are still facing challenges. And the recent difficulty faced by Cathay is stemming from the slow recovery of the cinema industry. Yeah, but that we don't expect that to have a major financial impact on FCT, given the revenue exposure is only around 1%. And we expect tenant sales to improve marginally in 2025, driven from rising international visitors arrival and also population growth. And additionally, there's also limited incoming retail supply. Yeah, coupled with the occupancy cost is still at below historical level. Yeah, so there's room for like further rental reversion in 2025. And therefore, we are anticipating a high single-digit positive rental reversion for suburban malls and also low teens for downtown malls in 2025. Yeah, next slide, please. And we continue to like hospitality subsector. And RevPAR in Singapore grew by 3% year-on-year in 2024, driven by a 1.5% increase in ADR and also 1.2 percentage point increase in occupancy rate. And Singapore's international visitors arrival reached 16.5 million in 2024, and this is around 86% of the pre-pandemic level. But it increased by around 21% compared to 2023 level. For Chinese visitors, it surged by 125% year-on-year, but it still remains 15% below pre-pandemic level. Yeah, so despite the year-on-year decline in RevPAR anticipated in first quarter 25, due to the absence of the major concerts, we do anticipate RevPAR to improve by low single digit for FY25. Yeah, next slide, please. Yeah, so this is the list of the REITs that is under our coverage. Yeah, just flash it for 2 seconds. Yeah, so that's all for me. I'll hand over to Ding for technical pause. Thank you.
Thanks, Pamela. Good morning, everyone. I'll move on to the technicals. So first start looking at S&P 500. Last week, we had a breakout of this downwards resistance line, as well as the 6,100 level, which has continued to act as a horizontal resistance. So I think with that, we are possibly likely to see new highs going ahead as long as the price holds above the trend line breakout, with resistance possibly next at 6,150 to 6,200 area and support at 6,065 to 6,100. Next slide. Yeah, so as we know, the Singapore index made a new all-time high last Monday. So we actually looked at the returns over these past 17 years as compared to some of the Asian markets, including the frontier markets, which are those developing markets. They are bigger than least developed market, but smaller than an emerging market. So actually for Singapore's index, we actually lack all these frontier markets, which are Mongolia, Sri Lanka, Pakistan. So over these 17 years, in US dollar terms, FPI was up about 6%. However, we did beat some of the laggards, which are Vietnam's index, which was down 30%. And also another notable underperformer these 17 years was the China's Shanghai Composite Index, which was still down a bit from its 2007 highs. Next slide. Yeah, so next one we have a technical buy for Beng Quang Marine at 25.5 cents, take profit levels at 28.5 cents and 30.5 cents respectively. Stop loss at 23.5 cents. Last close was 25.5 cents. So looking in terms of the chart, since the price made a double bottom at the 20.5 cents level in December of last year, price has embarked on a series of higher highs and higher lows, recently breaking above the 25 cents horizontal resistance level after a higher low build up with support at 24 cents. So that's a bullish signal with increasing momentum at MACD as well. So we are likely to see hit higher to actually retest these two previous resistance levels. Next slide. Next one, we have a technical buy for Lei Chun Group Holdings at 0.055, take profit level at 0.063, stop loss 0.051, and last was 0.060. So looking at the chart, in terms of the chart, generally it's trading within a rising wedge formation highlighted in blue. Recently, some bullish price action indicators are there. Price broke out above a range consolidation between 0.045 to 0.052 with a gap up on increasing volume recently as well. And it has consolidated within a blue flag formation with increasing momentum at MACD. So possibly we are likely to see price continue its recent bullish momentum to actually test the wedge resistance level at 0.063. Next slide. Next one, we have technical buy for ISO team at 0.066, take profit level 0.070, and 0.075, stop loss 0.062. Last was 0.070. So in terms of looking at ISO team chart, price was on a primary uptrend in around May to June last year, and it actually has been consolidating sideways for a very long period of time, especially in September to February this year, between 0.057 to 0.063. And price actually had a breakout of this consolidation recently with increasing volume on momentum and MACD as well. So we expect to see price retest the 0.07 swing high level point in September last year and possibly make a new high towards 0.075 next. Next slide. And next one, we have a technical buy stop for Tuan Sing Holdings at 32.5 cents, take profit levels at 36 cents and 40 cents respectively, with a stop loss at 30.5 cents. Last close was 32 cents. So looking at Tuan Sing Holdings, the chart is bullish as well. Price has been consolidating in an ascending triangle since October last year, breaking above resistance at 27.5 cents. And also recently held a throwback of the 29 cents breakout level. With that, should price break above the 32.5 cents level, it could head higher towards these two resistance levels next. Next slide. Next one, we have a technical buy for Ho Brothers Eco Engineering at 0.043, take profit level 0.048 and 0.052, stop loss 0.040, last close was 0.043 on Friday. So looking at in terms of the chart, price broke out above the ascending triangle formation resistance at 0.043 after forming a series of higher lows since mid-January this year. This came after a price broke out of a short-term downwards resistance line as well, with increasing volume and momentum in the MACD and the fresh bullish crossover. So with that, we're likely to see the price actually possibly retest the 0.048 swing high resistance from mid-December last year, and possibly form a new high at 0.052. Next slide. Next one, we have a technical buy for Pacific Radiance at 0.051, take profit level at 0.060, stop loss 0.047. Last close was 0.051 on Friday. So looking at Pacific Radiance, the chart generally has been trading within a main uptrend channel, and price recently broke out above a consolidation between 0.045 to 0.050 from November until now. So with that, we are likely to see price continue its primary uptrend and head towards the take profit level 0.060 to actually retest the uptrend channel resistance area. Next slide. Yeah, so for the summary of trades initiated last week, for Bengquan is currently flat. Lei Chun is up 9%. For ISO team, we hit our first take profit level at 0.070. It's currently up 6%. And for Tuan Sing Holdings, it's currently down 1.5%. So that's all from me. I'll hand over time to Paul to talk about ThaiBev results.
Yeah, thanks, Zain. Yeah, I'm not sure my IT. Yeah, anyway, for the first quarter, as the title suggests, it's basically been a slow start to the year. The results was generally in line with our expectations. With the EBITDA within that 25% because it's the first quarter. But the problem we have is the poor performance in spirits. Because spirits is almost 75% of earnings. So although you see the EBITDA for beer is as high as spirits, but because beer is only like 10-15% of the net profit because of minority interest and also the high interest expenses that they face. So in general, we are the positive is beer is continuing to enjoy the recovery. You can see here the revenue is up 8%. More important is volumes are up, and they have been above the 600 million liters for the past 2 quarters, namely in Vietnam and also in Thailand. So for Vietnam, it's really a macro recovery because the last 2 years has been exceptionally weak, and then for Thailand, it's mainly because of the tourism spending recovery. The negatives for me is mainly the spirits. So spirits is the key business because it's 75% of earnings, net profit. But what we do see is the largest volume decline in 2 years, year on year. But because the prior quarter has been exceptionally strong. So using quarter and quarter is always hard because every quarter they could stock up, they could stock the channel, then lighten up the channel. So quarter is hard. But I'll speak about it more why we downgrade. So anyway, we downgrade from buy to accumulate. I think we didn't move our forecast. Our target price also we dropped it. So the issue for me for ThaiBev is mainly the valuations. So we always thought that they used to trade at 18, then drop to 14, then 16, then now they're trading at 12 times, which is their 4-year average, and they are don't seem to be able to break out of this low teens valuations. And we think even this year, because the earnings could be sluggish and there's a modest improvement in consumer. So that's why we actually lowered our target valuations from 14 to 12. So one reason could be the structural weakness in the spirit volumes. I didn't put the chart, but anyway, the chart, if you take annualize, that means on a rolling 12 months, you will notice that sorry, I don't have the chart, but the spirit volumes actually been falling for the past 3 years. So that's why we think there could be a structural weakness in spirits because partly cyclical, but also because this is like a old man drink. Usually the farmers drink this, and there's a continued to be a lower consumption of it. So maybe that could be one of the reasons why the PE valuation multiple may not expand. Of course, the one caveat here is that this stock could get a pop if there is a listing of Beerco or there's a strategic stake sale. But of course, this has been talked about for the last 3 years, and I really have no timeline to tell you when this will happen. So that's why we still like it because it's cheap, but earnings growth is just very sluggish. Next slide. Q&M Dental. So we usually give an update. Of course, this is our update usually happens after having some conversations with the company. So we, as the title suggests in the previous slide, now we do see growth drivers are appearing. Don't flick the slide so fast. The first one is that the margins are improving. Firstly, the margins last 2 years in FY23 has been the lowest since listing. Because what has happened is that they've been on a major aggressive expansion, 40 clinics in Singapore, and then but right now because of that, their consolidation and then rationalizing the costs and then raising, and then they are focused now is to raise existing margins. So most of it is a lot of cost saving measures. Of course, if you're asking, like, this is not rocket science. I should have done it earlier, but I think they've been very busy with the aggressive expansion. So right now, small things like credit card payments or consolidating land suppliers, recovering consumer, these are things that will help creep up their margins. So the second growth driver will be the AI, which they actually been working on this since 6-7 years ago. It only rolled out the last 2 years, but it's making some headway. So just to give a backdrop of what this does, so it's an AI tool. So what it does is actually does an X-ray of your teeth, and then from that X-ray they will detect what are the problem areas automatically, and also give a health report and give recommendations. So this become a more unbiased way to treat a particular patient, because every dentist will have their own view. Last month, they signed an MOU to deploy this in 1,000 clinics and hope to have more and more on these licensing agreements. So licensing agreements means that if a particular dentist use this, then they have to pay a few dollars for every use case. That means every time a client deploy this X-ray with the AI tool or recommendation engine, then they will be paid several dollars. The last growth opportunity is M&A opportunities. So maybe not so well publicized here in Singapore, but in China, there's actually a major anti-corruption drive or crackdown. So there's a lot of investigations, a lot of the arrests and so forth. But what has happened is that the authorities seem to want to put pricing pressure on all existing operators, even private operators. So as a result, they're actually opening up foreign ownership in several cities because they want more capital, because local governments are already so tied up. And what we do see here is that Q&M is actually just recently make an acquisition. So we think these are fertile environment for Q&M to make more acquisitions because they can get better valuations. And one reason why the Chinese operators might want to have a foreign entity is they can actually hold prices if it's foreign owned. Because if it's locally owned, then I think you're going to get that investigation, you're going to get pricing pressure. So that will be the M&A will be the next growth driver, which is not new for Q&M. I mean, this was their mode of growth when they started to list. Basically, no change our forecast, no change our target price, but we just believe that there's new opportunities coming ahead for them. Next slide. Okay, my last corporate one will be, so for Oiltek, the key highlight is just that the earnings was up 60 and their dividends, they raised it by almost 70%. Next slide. So for Oiltek, the results was, the revenue was in line, but the profit, if you look at the left, the profit was up almost 58%. So it was above our forecast. So margins continue to climb, partly cost savings, partly a bit of timing too, because when you do project completion, I think we highlighted last time, because the way you do accounting for long-term contracts is you always make an assumption of gross margins. So let's say you assume maybe 5%, just give an example, but because you have to give a conservative consumption, then when you actually complete the project, usually there is the margin is usually higher, maybe 7%. So that's why when projects get completed, they typically will have, we wouldn't call it a write back, but they really have to adjust their assumptions, because during the project phase, as they recognize progressively, they usually have a conservative assumption. The negative is the order book. So the order book has been, if you notice at the very bottom, the order book is basically flat year on year. But for us, we think, and also revenue slope, we think the order book is a bit slower because they've been focused a lot on just completing, because the last 2 years, the order book like doubled, almost tripled. So the focus has been just to complete the projects. But we expect order books to be replenished. We are raising our 25 earnings to the 35 million on higher margins. Our target price is raised. We roll our valuations because we were using FY24 earnings. Then now we use FY25 earnings and we also raised it. So that's how our valuations went up. We are using like 20 times PE from 22 because the industry in Malaysia, which is the closest peer, is now trading at 18 times forward. So that's why we brought down. And of course, we gave it a bit more premium because they have a very strong balance sheet. The net cash is almost 180 million ringgit for Oiltek. So for us, the outlook, we expect them to secure more refining orders, which is palm oil refinery. So refining means you take the normal crude and then you refine it to like cooking oil. Not until cooking, to kind of palm oil that it can be sold, because you got to clear out the impurities and so on. So the demand will grow when there's more production and more acreage being grown outside Southeast Asia, namely Africa and also South America. The new growth driver for them will be, as the more and more investments into renewable energy, which is of course biodiesel in Indonesia and Malaysia, and of course also sustainable aviation fuel oil, which is basically taking the palm oil effluent, the waste palm oil, and then putting it into aeroplanes. Of course, not so much. Of course, only like 1%. But even that is really a lot. Right now, a lot of it is being taken from China, which is a used cooking oil. I'm not sure how the quality of it, but I mean that's how it works. Next slide. Next slide. So, okay, so there's no news. Not that we lazy, didn't do anything, but there's really no news. I think last week for Singapore, there was a lot more. So for the US, the main news was retail sales. I think the market got a bit worried that the retail sales was a little bit soft, but actually in general, it's still pretty strong. I think retail still is still very resilient. 3.9 is even better than Singapore, of course. Then if you take the PCI, so this was a bit of a worry because the inflation actually jumped up. I think it was the highest month-on-month, I think 0.45, right, and it's ahead of the market expectations. What was driving it was actually egg prices. So I think if you're eating egg in the US, I think egg prices suddenly spiked up because of some bird flu worries and insurance used cars. So I mean, the debate is whether this is one-off or not. Of course, egg possibly is. But anyway, next slide. Let me just move on to our technical views. So for technical views, was like what Zain mentioned, we hit an all-time high. So China, after 18 years, we're basically flat. There's a SGX review. So on our wish list, I mean, we're not holding our hopes high, but our wish list is just to remind that, access to capital is a strategic advantage for companies. So you can, what we mean by strategic advantage, so if you imagine like a Grab or Uber, the reason why they can do so well is because they got access to capital. But no, if you deprive the local SGX small and mid-cap companies from capital, it will affect their growth because, like I said, capital is another barrier to entry. But of course, right now, most of the domestic savings is earmarked for the privilege and also for overseas. So most of the money, the privilege now, is better to be overseas than be in Singapore if you want to get access to our local savings, I guess. And of course, the thing is that if the focus has been on reducing regulations, which basically means making the annual report thinner, I don't think that's going to solve anything and attract more companies to list here. Moving to DBS, which again, similar to last year, whenever they announced their full year results, when they raised their dividends, they become a REIT killer again. So what we mean is that it's going to be hard to recommend any local REIT when the DBS alone can give you 6.7%. And this will be at least for the next 3 years. And because they raised the earnings is like what Glenn mentioned, the earnings jumped by 35% to $3. And this $3 is paid every quarter. The reason why they can pay so much right now is even though earnings didn't jump 35, is that the payout is actually raised from 56 to 76 because of the new Basel III rules. They're returning 5 billion of capital through dividends. And on top of it, on top of this $3 dividends on the background, they're also going to continue to buy 3 billion of buybacks, and there's also another 1.5 billion of operational capital, which MAS kind of penalized them because DBS had all these big IT issues. But for this one comment is that DBS is like what it's not an earnings story for this year. It's mainly because of the dividend yield. Earnings may come from wealth management, but 75% of wealth management income actually is trading related, sentiment related, and this can swing anytime, just like SGX volumes. The last thing to note is, of course, it's all about the Trump tariffs, the reciprocal. Reciprocal. What Trump, I guess most of you know, but just in case, what it means that if you impose 10% tariffs on me, I will also impose 10% tariffs on you. No more, no less. I mean, that's what his Peter feeds it. But I mean, if you look at Asia, the countries which have the highest tariffs is India, South Korea, Thailand. But our base case is that there won't be that much impact because the worry is always the semiconductor companies that export to the US. That we are not so worried because the tariffs on Singapore is 0, and the tariffs on Malaysia is only 5%. Because most of the manufacturers' facility is in Malaysia, Penang and Johor. They are the lowest. Okay, but having said that, the tariffs that Trump is going to announce on 1st April and implement on the 2nd, or because he said April Fool's Day, he doesn't want to do anything. But anyway, is that the unknown is that the data where we show here, the 1713, this is all import data on all countries. So WTO doesn't have data on just US goods. So we're not sure what's the difference. The second thing is, of course, the unknown is global trade. So if global trade get hit, then it's going to affect companies like SETS, because we're not sure whether if US impose, then there's going to be a trade war, or no, there'll be some negotiations before that. So all this is unknown. The third unknown is that I think Trump has explicitly mentioned that even if you impose VAT, or like Singapore, maybe Singapore impose GST on US goods, this to him is considered tariffs. So if there's GST of 10%, then he will also impose an import tax of 10% on Singapore goods. I don't get the logic, because VAT is not meant to be penalizing, but again, this is what he views it. So there's a lot of unknowns of whether, although Singapore is zero, whether there's going to be any tariffs on Singapore. So yeah. So some of the events to watch on is Singapore budget. We don't think there's going to be any impact on the market. Maybe give you more vouchers to shop. Even then, I know some will ask whether there's only impact on Sheng Siong. Sheng Siong has always mentioned that the vouchers don't really move the revenue, because maybe they give you 300. So consumers don't expand the wallet because of the 300. They will probably just replace it. Then of course there are bank results and so forth for your this week we also have Manulife and also Prime, I think, yeah. Or maybe Prime is next week, sorry. But feel free to dial in. It's open to everyone. Last two slides. Okay, this is just an illustration. So the worry is this blue line. Of course, it's only 1 month, but if this trend continues, inflation could actually pick up. And also this on retail sales. It's generally quite stable for US. Last slide. Okay, so this is the tariff. So of course Singapore is 0, is on the far right. Malaysia is somewhere in the middle, is only 5.6. So the ones that have the highest are India, Brazil, Korea. So these are the ones that could be more worrying, because then the US could slap them. But again, it depends how much India actually exports to the US, which I'm not very familiar anyway. But this is just for your reference and just to get some sense of what are the tariffs involved. Okay, thanks everyone. I think we can move on to.
Yeah, thanks, Paul. Let me take some of the questions first. Let me just look through. Yeah, okay, let me just take this one first. I think this question is quite a few number of likes. What is the price outlook on UOB OCBC? Do we expect special bump up in dividends? I'll leave the TA to Zain, but for UOB OCBC, do we expect special pump in dividends? I would assume that, following DBS's example or lead, right, where they gave this capital return dividends. They also did an increase in dividends, and they're committing to even more dividends, right, in 2025, that they should follow suit in some form of capital returns. For UOB, they are more explicit. They did state that they would be doing a share buyback, but they haven't really given any details on it. So, at least DBS gave the amount, right? But UOB didn't give anything, but they did say that they're going to do it. They didn't mention, both companies, both UOB or OCBC didn't say anything about extra dividends or more dividends. I think even more interestingly is that they didn't mention about dividend payout ratio. So whether or not they will be increasing it from the 50% that both banks previously had said that they would stick to this 50% dividend payout ratio. So they didn't say whether or not they will be increasing. But I think quite interestingly, they didn't say that they would be really following it very strictly either for the fourth quarter of 2024. So I think we could be expecting some form of return, but whether or not it will be a long-term thing, or would it just be like, a fourth quarter, I give you a special dividend, one-off. Yeah. So we're not really sure if what would be the case going into the fourth quarter. But I think we can expect some form of returns for either company. Now let's move on to the next question. For DBS's 15 cents capital return per quarter in 2025, will it be in terms of Oh, where did the question go? In terms of cash or yeah, I think yeah, it'll be in cash. It'll be like the normal dividends, just that it will come in for one. They've committed to 1 year. Yeah, so you'll just come in like per your normal dividend. So someone asked also again, capital return initiative for DBS, 24 cents increase applies for 2025 only. How about the 15 cents capital returns dividend per year? Yeah, so this 24 cents is something that they have committed previously. It's not like a new thing where they say that, oh, they're going to give it. They did say that this will be an annual increment as long as they have the budget for it and that they have the capital for it. So it will come in every year. So that's why we saw this bump up in the fourth quarter by 6 cents. So we were assuming next year in 2026 that they will also give an increase in this 6 cents as well. And they said that yeah, they will follow this 24 cents. They're not going to remove it. And how about the 15 cents? Yeah, I mentioned earlier also that they will not they said that they can continue with this moving forward into the next year and the following year. So 2026, 2027, we could see a similar capital returns dividend, but we're not sure yet what is the amount and yeah, what is the amount basically. Yeah. But I think just to elaborate again, they do have a lot of capital. So even when they return so much and they're giving like a 76%, like Paul said, dividend payout ratio, it's not like they are spending, they're giving back more than they earn, right? They will still have a 2+ billion retained earnings that they can put back into the capital. So they're still holding on to capital in case there's any M&As, acquisitions that they need to do to continue to grow or even to grow their loan book. The thing keeps jumping. Hold on, let me find. I think I have a few more questions. Yeah, there's also another one asked also, OCBC and UOB raising dividends, capital return, same as DBS. I'm not sure if you will return the same as DBS, but I think we can look forward to some form of returns. Anyway, they're both releasing their results soon, so I guess it's just waiting to see what will happen. Okay, someone asked a few counters, Yang Zhejiang, Citrum, Propnex, Opa, but there's one about SGX, so I'll take the SGX one, I'll leave the rest to Paul. For SGX wise, it's really a volumes, you're riding on it's based on the volatility as well as the volumes growth. So it's quite volatile, right? The more volatile it is, the more volumes there are. So we have seen in second half of 2024, or for SGX, it's first half FY25, that their results did very well because of the volumes and the volatility. In this starting off in 2025 for January, we also have seen that their volumes have continued to grow. So both the SDAV and DDAV, so their securities daily average value and the derivatives daily average volume, have both increased for January 2025, and it's about around 11% year on year for both of them, for both these lines. And these are the main contributors to SGX's volumes as well as their revenues. So I think going into this, at least the first half of 2025, or in terms of SGX's second half FY25, we will continue to see that their volumes will be increasing quite steadily, mainly due to the high volatility, and with whatever Trump is doing, this will just continue to spur on the volatility. Yeah, there's one about iFast. Is asking, given its high PE, is there a concern to your team? What should be a more acceptable PE compared to our 3 local banks? Please comment. Yeah, for iFast, it's a very unique company because it's not just wealth management, bond company, sell bonds, or that kind of company. Now that they have diversified into a bank, right? It's really very hard to see what should their optimal PE be. If you compare to their competitors, I think a few, like Yang Zhejiang Financial, and these are not really, I would say, direct comparisons, or UOB Kay Hian or Hong Kong Finance. Their PE ratio is all around 10, right? Around plus minus 10x. In iFast you have like 37 times. So but you can't really say that you can compare it to them, or even if you want to compare it to a bank, it's also very hard to do a comparison to a bank because they're not a bank, right? from what I can understand from management, it's they're doing the opposite of a bank, right? So bank, you have your bank, your core banking sort of operations first, right? Like you do your loans, you do deposits. But with iFAST, they did the other way. Then sorry, for bank, you do deposits, loans, lending out money, and then you go into fee income. But for iFAST, they do the opposite. They went to wealth management, fee income, and then they now moving into a bank. So it's really quite a new, I would say a new kind of company. It's no real comparison to say that, oh, their PE ratio should be this much, this much. Yeah, so and we don't cover iFAST, so it's a bit hard for me to say anything about whether or not their PE ratio. But just to keep in mind that it's very different kind of company. Yeah, so you shouldn't be valuing it based on really any other competitors that they have. I think I got yeah, hi Glenn, why SGX sold down despite SGX review coming. I think it might be some kind of profit taking because the share price did spike up. And also, if you look at like I said, the volumes have increased in January, but it hasn't increased as much as the previous few months. So that might be one of the reasons, that they are possibly seeing some sort of slowdown in the volumes, but it's still healthy. The growth in the volumes are still healthy, at least for the first half of 2025, right? And it's also coming off a very low base that they have the previous year. First half of 2024 was quite bad. There was not much volume. Second half of 2024. Yeah, sorry, because of their financial reporting date is quite different. So second half of 2024, it wasn't a very good year for them because their volumes were down. So then you move into second half 2023. Then second half 2024, the volume spiked up mainly due to the high volatility and also coming off a low base. But now that you're moving into this new sort of comparison, the first half 2025 compared to first half 2024, the volumes it's still growing, it's still high, but it's not growing as much as it was previously. So that might be one of the reasons, and of course some people are also taking profit, from the share price basically hitting a new high. New highs, yeah. Yeah. Sorry, let me see. I think a few more questions for me. What's the Basel III rules in more detail? Yeah, it's really very long, but it's really how they value the risk-weighted assets for the banks. So I think in more detail, if you really need a long explanation, you can just drop me an email. I can explain to you over. Otherwise, it'll take me maybe more than an hour to get through that. Yeah, but basically, their risk-weighted assets are now valued differently, which is why they are able to get a bump up in the CET1, which is the Common Equity Tier 1. And if you look at across the three banks, for all three banks, UOB benefited the most from this change in Basel rules, right? It's because majority of the portfolio is in the SME and it's very highly, their LTV is very low and also very highly collateralized. So that's why they are able to benefit the most from this new change in Basel rules. Whereas the other banks also benefited, but not in that much of an extent. Why can't iFAST make new highs despite the growth? I think it's the banking's one, because I'm pretty sure the Hong Kong e-pension business has really been priced in, but I think they are now really banking on the banking operations, right? So that will be their new line of growth and a new way to trigger even more I think diversify from just doing fee income, right? So they're not diversifying. So they have proven themselves already once, by saying that we're going to be profitable in the fourth quarter. They did prove it. But I think the question is, how much more can they grow? Because what they're currently doing, right, is only just taking in deposits. They're not really doing not doing much lending. They're not doing anything. So they're just taking in deposits, and really it's just like a current account, savings account, CASA bank, right? They just take deposits. So they haven't said anything whether or not they're going to diversify. They're going to have more streams of income or revenue for the banking side, right? So they haven't really proven themselves that they are a real bank that can fight, with the other digital banks, maybe, or with even the big players, in their markets that they're in, which is in the UK. So I think that's the main reason why they can't make new highs, because they haven't figured out what is their true the path for the bank yet. I think they're also trying to work things out, and figure out where the growth will be coming from. Because for now, they're just focusing on growing the bank, first of all. I think that is all. Yeah, maybe I'll just hand over the time to the rest. Otherwise, they can't clear all the questions. Okay, thanks.
Yeah, just to top on what Glenn said, just to help you all understand what happened for Basel III, is that you know, for any typical bank, let's say you lend $1 on mortgages, you usually have to set aside maybe 40 cents of capital. But under the Basel rules, if your LTV less than 50, I think you set up maybe 20 cents. I'm just giving an example. So that's why the Singapore banks now realize that, hey, they got so much capital, they don't have to put so much capital for all the loans that they put aside. Mainly for residential mortgages. Yeah, this is one area, but just to give you an understanding why, because Singapore banks are the most conservative. Yeah, but anyway, yeah, I think we can move on to other questions.
Yeah, thanks, Paul.
Okay, I guess I'll take some questions. Can you give your view on C Limited uptrend on price, but profitable? Should investor take profit or hold? The thing about C Limited is, if you look at it fundamentally, pretty much all its three sectors are experiencing very strong growth, both top line and bottom line. But this is not something new. It's been pretty much the same story. We've been seeing the exact same trend over the last 3/4 or 4/4 or so. So when we came up with our target price, we actually already pricing all those, but the price keep jacking up, which is why if you look at our latest report, we actually have a neutral recommendation, even though everything was doing just fine. So I guess we're not going to jack up the target price unless we see something new that's definitely going to speed up its growth. If not, we feel like pretty much the growth potential is already kind of priced in. So right now, because of the price trends, I wouldn't say that like we're going to increase our target price further. So I guess we're gonna hold our neutral recommendation. So I hope that helps. I see another one asking about Shopify's free cash flow. Their free cash flow, if I remember right, grew around 36% year-on-year in the previous quarter, and the margin was around 22%. So when they actually do the outlook, they outlook the growth to be around mid-teen % year-on-year, which is actually a little bit slowed down. So it kind of disappointed some people. But Shopify, they actually commented on this. They say because they are really in a growth stage, so they see a lot of growth opportunities, and it would be a pity for them to pass on that. So they're really just trying to strike a balance between profitability and investing. So that is why they're forecasting down their free cash flow. Yeah, I guess that's all for my questions. I'll pass my time to the rest of the colleagues.
Thanks, Helena. Take on some questions. First question is between BRC and PenU, which one is the better trading buy? Yeah, that's a good question. Actually, both of these stocks are not really for short-term trading. Just to clarify it, our target price is for 1 year term. We do cover both companies. Both of our calls are accumulate for both companies right now. And I think, in my opinion, both companies have their own strengths. In terms of market share itself, both BRC Asia and Pan United are market leaders in steel and ready-mix concrete respectively. BRC Asia in terms of market share, it has 70% market share, which is larger than Pan United's 40%. And I think BRC stand out compared to Pan United in terms of their dividend yield as well, because their dividend yield is like 6 to 8%, which is very high. Whereas for Pan United, their dividend yield is around 4 to 5%. However, for Pan United, I think their strengths compared to BRC Asia would be their low carbon concrete, which has been able to drive up their profit margins. So even though there was a price decline in ready-mix concrete, their revenue can still continue to grow, and their profits can still continue to grow because of this low carbon mineralized concrete. Yeah, so I think that's a very strong point that Pan United have as compared to BRC Asia. So I think it really depends on your preference, but right now we have an accumulate call for both. Yeah. This question is, what will be the impact of Trump's aluminium tariffs and the likes on BRC, if any? I think short answer is that there will be quite negligible impact on BRC Asia, because during the briefing with management itself, management also don't see any impact on these aluminium tariffs on their steel, because I do suspect it's because right now China's exports from the US only takes up about 2% of US total exports. So even if US impose any tariffs on steel, it will be quite negligible impact on the steel prices. Yeah. I think the next question, when is WeHer going to release financial year result? Yeah, for this question, I don't have an answer, because I tried approaching management, but I think they are quite close up in terms of this. So if I ever have knowledge on this, I'll inform you as well. Yeah. There's a question, your views on Hong Leong Asia, Propnex, Oiltek, Pan United. I will comment on Hong Leong Asia and Pan United. Yeah, so for Hong Leong Asia itself, and Pan United, both of them are in the ready-mix concrete space. And I think it has been said a lot of times that because of the uptake in construction, it will definitely benefit building material companies like Hong Leong Asia and Pan United. However, for Hong Leong Asia itself, 80% of their revenue comes from diesel engines, and also 80% of their revenue comes from China itself. So actually, if you want to play construction, my opinion is Hong Leong Asia is not the right play, because 80% of their revenue comes from China and not from Singapore itself. However, for Pan United, 97% of their revenue comes from sale of this ready-mix concrete. Yeah, so it's a much more pure play construction as compared to Hong Leong Asia. Yeah. I'll leave the question over there. I think there's one more question for me. Hi Ben, how will the news between Broadcom, Intel, TSMC affect the individual companies? I think there's been some news about Broadcom and TSMC wanting to acquire some of Intel's business. This will change the dynamics a bit, because right now Broadcom's strength is in XPUs, which means customized processing units. So they work with, for example, Apple to customize the chips, and they can customize it to either GPU or CPU, for example. So them wanting to take Intel's chip designing unit will mean that Broadcom will have a more diversified portfolio, because Intel currently their strength is in CPUs, and traditional chips as well. So Broadcom wanting to acquire some of Intel's chip designing business means they want to diversify into different areas as well, rather than just focus on the XPU side. For TSMC wanting to take Intel's foundry segment itself, I think it may be a good news in the short term for TSMC, because under Trump's administration, I think with TSMC acquiring some of Intel's foundry business, it will mean that they will have benefits from US government's subsidies as well. For example, the US Chips Act, and I think regarding how it will benefit Intel itself, it will really depend on whether the contract price offered is at a premium of the current price. Yeah, so I think that remains to be seen, and we are still at a very early stage. Yeah. Yeah, I think that's all from me. I'll pass over the time to others. Thanks.
That's true. Also, for Paragon REIT, should unitholder accept the privatization offer at 0.98? Any chance for the offer price could be raised or competitive offer? Yeah, so we recommend unitholder to take it. And so citing the Fraser Hospitality Trust case, yeah, so Fraser Property offered to buy at 0.7 per share, and the offer was valued at 1.07 times to their net asset value, and also 43% premium over the past 12 months volume weighted trading price. Yeah, but the share price like increased by more than 40% after the announcement, but it actually failed to gain approval by unit holders. So following the rejection of the privatization offer, the share price dropped it by more than 20%. Yeah, so we recommend unit holder to take the privatization offer this time. And very unlikely they'll revise the offer since it's already like 1.07 times of the office price to NAV. And yeah, hope it answers your question. Can you give a view on Lendlease, who is trending down and their CEO has resigned, still a buy rating? Yeah, so we believe there won't be any impact on Lendlease strategy after the CEO stepped down. Yeah, so they'll continue to divest GEM, and then the rental review of GEM office is already done. And yeah, so our view for Lendlease remain unchanged. Yeah, it's still a buy rating. Yeah, just the potential risk we would like to watch out for is the adjusted ICR, which is 1.5 times. Yeah, it's just on par with the MAS threshold. Yeah, however, we do believe the risk has already been factored into the current share price level, since it's trading more than 30% discount. Yeah, compared to during COVID period, it used to trade at more than 10% premium to its book value. And Darren, StarHealth Global, is it being on privatization offer and the outlook for the next 12 months? Yeah, so StarHealth Global is not on privatization offer. It should be Paragon REIT. Yeah, that has been offered for privatization. And rental reversion for both the retail and office list continue to be strong, and with single-digit positive reversion signed up for both Singapore retail and office lists. And we expect further value extraction from the potential Wisma AI work. Yeah, so they are converting the car park into office. Yeah, and this will begin middle of 2025. Yeah, so they'll convert level 7 car park into office area to free up around like 3,000 square feet of the NLA. And then assuming referring to like their previous divestment price of the strata units, which is around 2,100 SGD per square feet. Yeah, so the additional GFA could roughly like give them around 7 million. Yeah, if they want to divest the additional GFA. Yeah, and for sets, what's the causation of the price moving down and outlook for the next 12 months? Yeah, so the volatility for the share price for sets is mainly because like the China-US tariff, and then especially with the removal of the de minimis tax policy. Yeah, so essentially it's like originally the item that is below $800 is not subjective for the tax. Yeah, but now they actually remove it. Yeah, so these are weighting down on the e-commerce demand. Yeah, since now they need to pay the additional 10% tariff. Yeah, so therefore it will subsequently hamper the growth of the cargo volume for sets. Yeah, so we do expect we don't expect any impact on FY25 result since there's only like 2 calendar months left for this financial year. And the negative impact will more on FY26 onwards, and we anticipate it to be around like mid-single digit impact on PATMI. Yeah, so we are factoring in around like 15% reduction in e-commerce volume because of the price elasticity of demand is around like 1.5 to 3 times. 1.5 to 3. Yeah, so we are just assuming a 50% decline in e-commerce volume. This should be roughly like at most 50% of the entire cargo volume. And the cargo revenue is around 50% of the entire group's revenue. Yeah, so roughly it's about like mid-single digit decline for their PATMI in FY26. And SEX is actively working on like the mitigation plans. such as consolidating unit costs for their customers and also like bypass tariff by finding a middle point, like such as from China you can ship it to India before shipping to US. Yeah, and we do believe like even with the additional 10% tariff, Chinese product is still very competitive. Yeah, yeah. Hope it answers your question. And what's the outlook for Suntec REIT? The outlook for Suntec REIT is a bit muted, and for Singapore side is still strong, and office we do expect like rental reversion for office to be around single digit, high single digit, and retail should be around 10 to 15%. But UK and Australia office market will still be challenging. Essentially, like when there's like supply influx in CBD area and the net absorption is still negative. Yeah, since the new demand hasn't been committed yet. Yeah, so we do believe DPU will probably be flattish or show like marginal decline this year. And your Far East Hospitality Trust target price and what's the timeline? What's US Fed interest rate this year? Yeah, so our investment horizon is usually 1 year, and we do anticipate around like 2 rate cut this year. So probably they are targeting at around 4% to 3.75% by the end of this year. And moving. Just wondering why REITs moving up today, such as CSOP, EDF, and Mapletree after languishing most of last week's. Yeah, so we believe it's just a normal volatility. Since like pretty much all the Singapore REITs result has already been done, and then all the negative points has been already factored into the current share price, and the investor probably starts to accumulate rates with the expectation that there will be rate cutting in second half onwards. Hope it answers your question. And is there any updates on MIT on MS coverage? Sorry, can you specify by MS do you mean Morgan Stanley or Morningstar? And some updates on MIT is tenant has vacant 3 data centers, which the lease has already expired in December 24. Yeah, and the data center generates gross revenue of around 8.2 million, which accounts for around 1.2% of MIT's gross revenue in FY24. Yeah, we do anticipate some leasing downtime, and the management is actively working on whether to relet it or redevelop it for other usages. We believe the downtime will be limited given the last like the last rental was like below market. It's around like $2 per month per square feet. Yeah, which is lower than the current market rate. Yeah, but management is considering conversion for alternative usage, such as the laboratory for life and science, and also a clean room for manufacture. Yeah, but we do expect limited downtime for the 3 data centers. Yeah, and any comments on SIA Engineering on the good result? Yeah, so they reversed from loss making yeah, compared to last year this time. Yeah, so operating profit for third quarter 24, third quarter is around 4.7 million. And we do believe MRO demand is likely to remain strong. But the industry is still like trying to deal with the supply chain disruption, yeah, and rising cost. Yeah, but for the medium to long term, we believe the demand for MRO will continue to be strong. Yeah, that's all for me. I'll hand over to Paul. Thank you.
Yeah, thanks. I'm not sure I can. Yeah, there are almost 50 questions. So I apologize if we can't answer all of them. So sorry. Maybe if you post them into our P3, maybe then at least we have time to answer. But let me just run through some. Oh, sorry, my video. Hi, Paul. Given the current hot China equity market, what are your views on SDR? I can just give you my view on SDR, not the Chinese market, but the SDR, the advantage of trading in SDR, I don't think the Thai SDR has much advantage, but for the Chinese SDR, I think the value is just the trading size is smaller. I mean, like, I think the trading size for SDR here is 10-1 for some stocks and then 5-1 for some stocks. Yeah. But of course, we all know the excitement. The excitement is essentially because of the whole AI phenomena is also coming into the whole tech store. I think Alibaba is up like 40+% from the lows. So I think that's causing the excitement. We don't cover the whole China market, but just to give you a sense, the benefit of trading SDR. So there is for the Hong Kong, it's just smaller size. And of course, it's I think local currency. What's driving the upside of Wilmar share price after tanking? It could be some assignment of China, but so far most of the things we monitor like sugar price, soybean crushing, hog farm prices, we don't see anything exciting there. Palm oil price maybe has rallied a little bit recently, so that could it's more of a mixed view for me for Wilmar. Some parts are doing well, but the China fundamentals is still the main issue that we will have. The briefing will be on this coming Thursday, and we can share more. But so far, most of the indicators we watch, like soybean crushing, consumer spending, all hasn't been great in China. So China is the one area to resolve for Wilmar. Yeah, which I don't think we're positive on the China. What's the outlook next steps? I think you answered this really right now. This one, yeah. Can you please take it? Yeah. So Paul, what's driving out the uptrend for Samudra? The only thing that we could see, they don't give any briefings, they don't update investors anything, only once a year. But what we do see is the container rates has recently spiked up the last 1 month. A lot of it could be driven by the front loading. So if you measure the China to Shanghai to US container rates, I think they spiked up, I think 20% this month. I think the last 12 months. Last 1 month. So I think that's why that could be one of the driver that people are getting excited of container rates. We are a bit more sanguine, we're a bit more cautious because if with the peace still hanging on in Gaza, then if ships, I think we mentioned before, if ships start to use the Red Sea gradually, then we worry container rates could become under pressure. Paul Yang Zhejiang, financial, please comment on the catalyst solution. Okay, so there's been a few questions on Yang Zhejiang financial. I think there's no real change in our view fundamentally. It is definitely cheap. I think even at now, the book value is 110. The share price is 50. Price to book of maybe 0.5. The recent rally, maybe it was 0.3. And but of course, you have to compare with what? And also compared to the Chinese banks. So Chinese banks have also rallied very hard. The last 6 months, I think the Chinese banks are up about 30%. This year, they're up about maybe 9%. So the sentiment for Chinese financial sector has definitely improved. And I think that's what's pulling up. My thesis for Yang Zhejiang Financial, why we never liked it is because, number one, they are in a transition. They have a balance sheet of 4 billion. Most of it, half is roughly, half is cash, half is loans. So they're taking all the loans out from China and putting it into investments here and building an asset management firm here. But like I said, this take 2-3 years to generate revenue. In the meantime, you will notice most of their loan income, that means they're lending money in China, but if the loan book continues to shrink, then of course interest income in China is falling. So they are in the transition, so that's why the earnings is weak. Valuations is of course attractive, 0.5. No, but when you compare that to the Chinese banks that are paying 6%, I thought China banks look more attractive. But of course, maybe that's lifting the sentiment, but I don't think it is due to any turnaround in the financials for them. Because again, it is a transition. They're pulling out their assets out of China. Maybe next year it could bottom out, then maybe that's why people are excited. So until you see that whole transition, because earnings will continue to fall. So that was the thesis that we had. I mean, fundamentally, but of course, sentiment on China has improved, so maybe that's why. Many small caps are breaking out. Is there a major fund inflow? I seriously doubt that. I don't see why I said that. So far, I've not noticed any. Because if any fund want to take buy small cap, they usually have to cross 5%. So I don't think. But again, small cap very momentum driven. I think no need to inform everyone. This is, of course, everybody knows this. When one or two small caps does well, of course, there's a lot of profits by investors. So it builds up the risk appetite, and it's only psychological. And of course, there are some pockets of small cap that's doing well. I think Marine is the one that is taking the lead. Like we said, like Nam Chong is taking the lead, no, Marco Polo. So Marine sector is taking the lead. Then we got the construction sector also performing well. Of course, there are some one or two like Oiltek is a bit not related to any of this. So I think these two main sectors, marine and construction, is the one pulling up the whole. And this is very unique to Singapore. I mean, so we're not really used to be, tech stock, semiconductor, which of course the last few months hasn't gone anywhere. But the new leaders for small cap, and that could continue, like we mentioned, like Yip Ban mentioned, construction doing well, and marine is also picking up. So we got some leaders in marine, and this is the one that's pulling up. In general, I'm not saying every small cap is due to marine, and of course, property is also doing well, which help Popnex and also APAC Realty. But major fund flow, I think this is still a very retail centric, because funds hardly take big positions. Yeah. But of course, the thing is when funds really come in, that's where you want to sell, right? When the big funds, if a Fidelity or whoever take a big stake in a small cap or mid cap, that's the time when I think it's time to get off the bus already. Because then no one else is going to buy. The big guy has already taken. What's your view, Young Just Season, considering the recent share price? Yeah. I still think Season probably usually it trades in waves. So after this, the results, I don't think anything great coming up there. But then there's still 2 or 3 more FPSOs. If you recall, we mentioned before, Seatrium even mentioned they could be getting 2 or 3 FPSOs from Petrobras. Which so far Petrobras hasn't announced anything. So I think that could be the thing that could rally. Let me answer 2 or 3 more because I think we're crossing the 5:45 really. Q&M Dental, is the EM2 AI competitive advantage? Does this kind of tech have low barriers? No? Okay, firstly, although they name it AI, I wouldn't really tag it as an AI, because AI, you need a large language model to support the whole. I think it's more like a software rather than an AI. I mean, that's my own view. I don't think there's many out there, because this was developed in-house by dentists because of their huge. I think they got 200 dentist pool. So you know how painful it is, right, to get dentists to work for you. I mean, to help you do this. So this is the barrier to entry. Their own dentist pool, and there's still a Singapore dentist, which our healthcare is it's taken with high regard. So that is the main barrier to get dentists to work with you, which is as painful as pulling out teeth, because working with doctors, it's not the easiest thing to do. And they've been developing this for the last 4-5 years. So this is like industry developed type of software, not so I think that is the main barrier. And so far, for them to secure a 1,000 clinic chain, which usually are distributors, I don't think there's a 1,000 clinic chain. We think it's a distributor. And for the distributor to add you in that means I don't think there's any competitor out there. Not that I know of, of course. Yeah. Okay. Paul, what's driving the price movement of Rex? I really do not know. I mean, Rex, they're like silence of the lambs. They don't tell you anything. Yeah. And the problem with investing in all these things, if investing in all these oil and gas exploring companies, you need a bottom-up view, because you really need to have a view on production. You need to have a view on the reserves that's coming up. Otherwise, this style of stocks can really tank. So if they don't tell us, I mean, then what? You're just buying on the share, on the oil price itself. Yeah, which we do not know. Sorry, I mean, just to get the better answer, we do not know. What to expect from Citron results? I think it will be a rebound, but I don't think it'll be that strong, because I think they are still facing a lot of overhead costs, which they need to clear out maybe by this year. So, for me, I think I'm watching is the overhead costs, because since the merger, they've been trying to consolidate and remove kind of the cost. So mine is more the cost structure that they have. Yeah, and don't be too late, because shipbuilding companies like Yang Zhejiang already make like obscene amount of profits. By the time you turn around, the whole shipping cycle might be over. So for me, mainly is to how much cost are you taking out from your cost structure. That will be what I'm looking for. Yeah. Of course, they will turn around because the order book is so huge. Do you think the small free float due to single large shareholder is holding back all shares? In a way, it could be because Oiltek, 70% of the shares or 68 point something is held by Cole Brothers. And if you don't have a big float, then you very few funds will want to take. I mean, they were very lucky. I mean, and of course the industry as a whole very lucky that AGT is one of those few funds that are willing to take. That means they're willing to take a 5% stake even when the liquidity is very thin, because you really have to take a long-term view. Not many funds hold it, but if your float is high, then it will benefit, and then at least more and more funds can be attracted to you. Otherwise, funds will stay away if the liquidity is thin or tightly held. What's the okay? Paul, what's your view on Vilma and upcoming results? So I'm a bit mixed. I don't. The problem for Vilma. Okay, last quarter I got it wrong. I thought it'd be very strong, but the sugar price affected it. So this time around, I think it's mixed. I don't think dare to stick my head out. I have to get knocked down. But I don't think it'll be very strong results. That's my own view. Because sugar not doing well, crushing is also coming down. What's the outlook for Pacific Radiance reporting? Yeah, they should report, but I'm not expecting strong results for Pacific Radiance for FY24. The real strength will be in FY25, because most of the contracts that they got for the new vessels only come in slightly in the second half, so full year won't be there. So you get the full benefit of the new vessels and the CTVs that they're constructing, the two CTVs which nobody believed they're constructing, but they are constructing, will benefit in FY25, not so much in FY24. I don't have the data, but again, most of them have to report in the next 2 weeks, so that's why I didn't really even have to go and ask. Because it's only in 2 weeks' time. Everybody has to report. Why Yoma spiked last week? I mean, they gave an update, but I thought the update was pretty weak. Property was good because property has an order book, but the Wave Money, which is the fintech, didn't do really well, and the F&B also didn't do really well. But I mean, Yoma has a life of its own. The share price, I get questioned on it every day. Yeah. Any dividend is PC for existing shareholder of when listing? I think that could be a possibility. I think they will do that. It will be existing shares. I think they hinted that before, if I'm not mistaken, but no structure has been confirmed. Yeah. Yeah. Okay, I think I probably going to leave some to Zane. I will type out some as much as I can. So sorry because there's still like 20 over questions. Zane, I think I pass to you first. We'll type on the rest. Yeah.
Okay, thanks for to some of the TA questions. Yeah, so first up for Bank of China, I think currently still very nice steady uptrend over here since breaking out 380 level. So a bit of resistance around 430, but I think we are still likely to see new highs ahead. Next resistance level possibly at around 450, I feel. Then for Singapore, I think it's still a very nice uptrend recently since the breakout of this range consolidation at 319. And it looks like a bit of a retracement on decreasing volume, so that's still okay. I expect price to hold support around 330, which was this prior resistance. And this is also around the 10-day moving average as well, which was around here, which the 10-day MA was the support over here when price did a throwback breakout at 390, then continue upwards. So I think we'll still likely extend this uptrend after a breather. Next one is Asian Pay TV. So for Asian Pay TV, I think generally this not much volume, but recently looks like price is able to get above 0.082. So I think maybe a slight bounce towards 0.085 previously. This was a strong support that could act as a resistance still. This was back in 2023 August. And next questions. What's the outlook for Marco Polo and Lion OCBC HST? Yeah, so for Marco Polo from TA point of view, I think it's just nothing too much for now, just moving sideways. 0.052 is support when it comes to 0.057 to about 0.060 is a resistance. So it's just trading sideways since October of last year. So I don't think anything much for now. Then for HST, I think overall it's still very strong price. Last week a bit of retest. Actually, we tested this swing high resistance at 88.5 cents and continue to move higher. So I think it could still extend the uptrend. Next resistance level around 95 cents, which today is just a bit shy of at 94 cents. And then next level will be around 99 cents for HST. So I think could still extend its uptrend as long as it stays above the recent swing low level around 87 cents. Then next question. Okay, some SGX question. First one is semiconductor industry. So I think for now a bit of a slight weakness. Price looks like it's pulling back over here. Recently just rebounded from this swing low around $5.30. So I would still expect price to just trade this a bit of a downtrend channel for now. Some resistance around close to 550 about there. Yeah. For Keppel, I think nothing too much for now. Keppel just trading sideways, range consolidation, largely between about 670 to 690. Yeah, for now, just sideways. The next question is on iFast. So for iFast, I think, yeah, currently retesting a bit of resistance area around 790 to 810, this area over here. So maybe a bit of a consolidation afterwards, but if you can hold above, like say 780, 790, this swing high level, which there was a bit of a slight consolidation over here on Friday, then perhaps it could still move a bit higher. So generally, might be trading in this blue color uptrend channel over here. So above 810, the next recent level could be around 830 about that. Yeah, so maybe a bit of a consolidation first, and if you can hold the higher low, then I think we could still see a bit of a slight upside. Next one is Samudera Shipping. Samudera, I think is close to this swing high resistance level, which was high volume back in start October last year around 92 cents. So this I think will hold as a bit of resistance. Then maybe a bit of a consolidation sideways with support around 88 to 89 cents area. Okay, then for CICT, I think a bit of a positive signs recently. Price is trying to break above 196 level over here, a higher swing low being formed. So I think as long as this 196 can hold, we could see a slight bounce towards this $2.01 to a 2 cents resistance level over here. And next up is Ascendus REIT. For Credit Ascendus REIT, also looking similar. Another test of the resistance around 258, but with a higher swing low, higher low building from over here around 285 previously. So I think there's a chance for price to break above this resistance, but I think still a lot of resistance outwards. Previously around 263, 264 would be the next resistance level. So maybe a slight bounce similar to CICT. Okay, next one is SRT, which is the CSOP S3 ETF. So yeah, looking in terms of the S3 ETF wise, I think still nothing too much for now. Just moving sideways, lows between 70 cents to 72 cents. I think price is likely just moving sideways for now. Then for Mapletree Industrial Trust, I think still rather weak as compared to some of the other REITs. But holding around $2 this level, this support level. So I think just maybe just moving a bit sideways over here. But now since the sell down, I think was last week, and volume has declined as well. So maybe there's a bit of sideways with resistance above like 206. Okay, then next one is for sets. Yeah, for sets, I think could be just moving a bit of a sideways for now. Since the retest of this since it felt this price get over here around 322, I think 322, 323, then a bit of a rebound, just consolidating sideways at this price resistance. So maybe I think price could do a bit of a range consolidation for now, between like 323 to 338 about here. Then what's the views on Hong Leong Asia, Propnex, Oiltek, and Pen United? So I'll give a TA perspective on it. For Hong Leong Asia, I think a bit of slight weakness in the uptrend recently, as price is broke below this upward support line, firstly at 97 cents, also below this resistance breakout level at 95 cents. Then in terms of the moving averages as well, where the yellow line, the 20-day moving average, was holding as support previously, now it broke below it as well with the high volume last week. So I think we could see maybe slight pullback, but I do expect price to still find support around 91 cents this level, which was this range consolidation over here. So that's a bit of a slight breather, I feel. The next question is on Propnex. Okay, for Propnex, I think price retested the resistance previously at 113 on I think just a bit of the uptrend is still very strong. I think just a bit of a consolidation for now, where you see this very low volume consolidation after price spike on high volume. So maybe something similar over here, when there's high volume, then price went up, then low volume just consolidates sideways, then probably another high volume coming into continue uptrend. And in terms of moving averages, recently I think the 10-day moving average in REIT has also been holding as support. Likely 110, 111, I think should hold as a bit of support for now. So we just a bit of sideways, then would see the uptrend continue a bit. For Oiltek, there's also a question on what's the good entry price. So for Oiltek, I think still holding along this upward support line over here. So a good entry price for now, if it does hold this support line, about 117, about there. Yeah. So recently, I think possibly it's holding like a ascending triangle formation where it did a retest of the 124 resistance, but still holding some higher lows along the way. So I think if this can hold, then possibly if it breaks out 124 again, we're likely to see new highs again. Okay, then for Pen United, I think similar to a bit of Hong Leong Asia, just a bit of a slight weakness recently as price just came down a bit recently below like 62.5 cents level. Then in terms of moving averages, also below like the 10-day MA previously at around 63.5 cents. So I think for now we might see a bit of a slight consolidation. If it can't get above 63 cents in the next few days, I think maybe a bit of a slight pullback towards like close to 60 cents level. Then I think this will still go as support. So just some consolidation for now. Okay, then there's a question on what's a Apple DC entry price and for SIA? Yeah, so for Apple DC entry price, I think it's trading sideways for now. So an entry price, assuming the range still holds, is probably around 209, around this level, horizontal level over here. Yeah. And for SIA also just sideways for now, between like 626 to about 645. So possible entry price could be near this support, around 625. Yeah, I'll answer the last question on RH Petrol Gas. Yeah, I think for now there was a large spike then to test this swing high down close to 19.2 cents, so a bit of a retracement down. So I think for now, reconnect back with the 5-day MA. Over here might be some support if it does hold this 18.3 cents level. Yeah, then it could just maybe trade sideways for now. Some resistance I would think for now close to around 19 cents. So maybe just it might do a bit of a bull flag kind of pattern, just consolidating sideways on lower volume for now. Then for E14 is TJ current time. Yeah, for this I think discounted not much volume, just 100 over 1,000. For this, I think overall very range bound, so between like $2 to about 240, high 240s. And for now, it bit of a rebound back to this level, some resistance at 220. So I think this will still hold as a bit of resistance. Just trading sideways, perhaps between that 210 to 220 for now. Yeah. Then next one is Digital Core REIT. So for DG Core REIT, I think also quite range bound. Since it tested this support around 52 cents, there's been a bit of a rebound back towards this previous support level area around 57 cents. So this is likely to hold as a bit of resistance for now. Since previously this was quite a strong support, then price broke down. So I think here we have some resistance for now. So I think that's all for the TA portion, but feel free to post any questions you have on the P3 community group. I'll take it over there. Yeah, I'll just have a time to rest of my colleagues for, I think that's 2 more questions. Thanks.
Yeah, Meow. Yeah, okay. Let me just take this so we can end it. Is it Meow, is it reasonable to take the DRP for Star Hill Global offer at 49.21? I think no purpose. I think if you want to take the DRP or the dividend reinvestment, it better be a discount because the share price is already trading at 49 cents. So I don't see any purpose of doing it. You might as well just buy straight from the market. The DRP should be at least cheaper than what you can get. Otherwise, there's no purpose of doing it. Yeah. Yan Lo, any update? Yeah, sorry, there's really no update. We will try and give you a Phillip on the ground once the results is out. They haven't sent the invitations yet, but once it's out, we'll try and update everyone. Yeah, so sorry for that, Jeffrey. Yeah, there's nothing new to update. Yeah, we're just waiting for just the next 2 weeks. Yeah, thanks. So with that, I'd like to thank everyone for your questions. Some of the questions we typed in because we didn't have time to mention here. But anyway, thanks everyone for your time. I hope it was useful, and then wish everyone have a good week ahead. And thank you. Yeah, take care, everybody. Bye bye.